Good morning, everyone. Did you catch up the latest boss from the Federal Reserve? It's incredible how a single decision from them can send shockwaves through global markets, sending trillions of dollars in an instant. But what does it mean? Let's break down the headlines. There have been a lot of talk about Jerome Powell's latest hints and the market's eager anticipation. But beyond the headlines, it's crucial to understand the bigger picture. How these decisions could play over the next few months and what it means for your investments. Is this a shift in the economic landscape or just more ripples? Remember, when Powell made that light-hearted jab at the good, cheap, transitory, it wasn't just a joke. It was a good reflection on how even the most seasoned experts can misjudge the situation. This is a powerful reminder of why staying flexible and adaptable, just like the Fed, is essential in these times. As we dive into the discussion, keep in mind how sudden rate cut might affect your investments. But more importantly, think about how you can stay ahead of the curve by adapting your strategies by response to these evolving signals. Just last week, the world's attention was focused on the Jackson Hole Symposium, where Jerome Powell dropped some major hints about the future of interest rates. Could we be on the brink of a significant shift as early as September? The anticipation is palpable. Powell emphasized that while inflation is inching closer to the 2% target, it's not quite there yet. At the same time, the job market, once red hot, is beginning to cool down. This presents a delicate balancing act for the Fed. Do they continue pressing down on the gas, or is it time to ease it up? It's like losing your grip on the wheel when the road looks smoother. Even a slight adjustment can have a big impact on the markets. Take a look at what the chart on the screen. The market reacted with a cautious uptick in the iShares 20 plus year Treasury ETF, or TLT, reflecting investors' tentative optimism. If you are closely monitoring your investments, this might be the moment you've been waiting for. But remember, just as the Fed is adapting its approach based on new data, you too might need to reconsider your strategy as we head into the later part of the year. Let's dive into the market reaction after Powell's Jackson Hole speech. Picture this. You are watching your favorite sports game and one pivotal play completely shifts the momentum. It's exactly what we witnessed in the markets. When Powell hinted at rate cuts, stock rallied and investors sighed in relief. But here's the catch. The excitement was short-lived. Much like when your team scores a quick touchdown only to have the other team immediately respond. So why didn't the rally last? It's all about follow-up. The subsequent economic data, particularly softer job numbers, poured cold water on the initial wave of optimism. It's like anticipating a blockbuster sequel only to find it doesn't quite live up to the original. Take a look at this chart. Both the SP 500 and Treasuries posted simultaneously weekly gains for the first time in over a month. Pretty fascinating, right? But it also serves as a stark reminder of how quickly market sentiment can shift. That's why staying on top of these changes is crucial. Now let's turn the focus Back to you. When the market sends these mixed signals, how do you respond? Do you stick to your own current strategy, or does this make you rethink your approach? Whether you are following stock, bonds, or just trying to understand how these developments affect you, navigating these market twists can be quite the challenge. Let's dive into the mixed signals shaping our economy. It's like following a GPS that keeps recalculating or senten vuelta to turn or stay straight. Rising labor costs typically point to inflation, but with wage growth slowing, those inflationary pressures might not be as severe as expected. The economy feels both accelerating and braking at the same time. It's confusing, right? While retail sales are up, the slowdown in GDP growth suggests the economy may be losing momentum. It's like economy is confidently saying, I'm strong, while quietly acknowledging but not too strong. This graphic highlights the talk of war within the economy. Industrial production is rising, yet the manufacturing sector struggles. These opposing forces create uncertainty on investors. So, what does it mean for you? These mixed signals make it challenging to decide where to invest. Are we on the same path to growth, or should we embrace for more slowdown? It's like dressing for an unpredictable weather. How will you adjust your investment strategy amid these conflicting signals? Stick what's been working or tweak it based on the latest data. While we are not giving financial advice, staying informed and adaptable is crucial as the market processes these evolving trends. Let's dive into Powell's economic outlook from the Jackson Hole Symposium. He likened the current situation to walking a tightrope, balancing the need to respond immediately to economic shifts while keeping a focus on long-term stability. Powell highlighted the mixed economic labor signals. Labor costs have risen, potentially pushing inflation higher. But moderated wage growth suggests the pressures might not be as severe as once feared. While Powell noted that the economy is growing at a solid pace, he pointed out that different sectors are moving in the opposite directions. Some, like the labor market, are cooling, while others, like industrial production, remain strong. This creates complex environments that challenges investors. Navigating these mixed signals is, though Powell stressed that the Fed's actions will continue to be guided by incoming data. Whether to bet on the growth or prepare for a slowdown will depend on the evolving economic landscape. So, how you should adjust your strategies with such conflicting data? Stick to your current plan or make adjustments based on what's coming ahead? While we are not offering financial advice, Powell's cautious data-driven approach can help guide your decision making. Where do you stand after hearing Powell's insights? Leaning toward optimism or considering a more cautious approach? With everything happening, should treasuries be on your radar? It's like deciding whether to join the dance mid-song. Given today's economic uncertainty, treasuries are seen as a safe haven. Yields are attractive with 10-year at 3.89% and the 30-year at 4.15 roughly, with a 70% chance of recession within the next year, like accounted for some analysts. Treasuries offer stability that's hard to ignore. But timing is key. If inflation picks up, these yields may not seem appealing. Powell noted that while inflationary pressures from the labor market have eased, the broader picture is complex. Inflation expectations remain anchored, but the Fed's approach is data-dependent and ready to adjust. Global factors like economic nationalism could affect treasury yields. Shifts in international trade or global policies might change what looks like a safe bet. It's like dancing to a song that suddenly changes tempo. Adjustment is actually crucial. So what does this mean for you? If you are considering treasuries, stay attuned to product trends. Confident in the current rhythm or sensing a change? Balancing risks and rewards is key while you join the treasury dance or sit it out. While we are not giving financial advice, understanding these dynamics will help you decide your next move. What's your choice? Join the dance or watch from the sidelines? As we wrap up, it's clear that the Federal Reserve is navigating a complex landscape. Powell emphasized that while inflation is moving closer to the Fed's 2% target, the journey isn't over. The Fed remains committed to balancing its dual mandate, maintaining price stability while supporting a strong labor market. Powell noted that the cooling labor market, with unemployment slightly up but still historically low, this suggests that inflationary pressures from the labor market are unlikely to surge in the near term, giving the Fed some room to maneuver in its policy decisions. The direction is clear. The Fed is moving from a highly restrictive stance to one that is gradually less restrictive, with the timing and pace of rate cuts depending on incoming data. These shifts requires investors to stay adaptable as economic signals continue to evolve. So, as you consider your next steps, think about how these developments might impact your investment strategy. Are you prepared to adjust your sails as economic winds change? Staying informed and flexible will be key as we navigate this uncertain path together. This is my final position. Personally, I've invested in treasuries to seek stability amid current uncertainties. For me, they offer a safer option while I wait for more clarity on the broader economic landscape. While this approach aligns with my comfort level in managing risks during volatile times, it's important to remember that everyone's situation is unique. Keeping an eye on how the economic outlook develops will help in making informed decisions going forward.